It's a chart that I showed, I don't know, 20 years ago or so. Here it is again. I'm working with the colors. It's a little busy. Oh, that looks okay. I like that. We'll get this out. This is a really cool chart for Bloomberg Radio. We'll get it out. Twin deficits. Add the fiscal deficit to come. Add the twin deficits to come. And here's where we are. JPMorgan publishing this morning a long note on twin deficits. John Normand, is that what's in order? We're going to have twin deficits?
Well, that's guaranteed. I think the only question is how large is that twin deficit going to be? And what kind of rate compensation is the Fed going to offer the rest of the world in order to finance that? And my view is that Fed rates are going up. I'm just not sure they're going up enough to plug the deficit. Back
to the chart, 8% in 1985 when this was ancient news. Are we going to get back to that level or breach through to crisis levels as we saw in 2009?
No, I don't think you get to that level, partly because the global economy is going to provide some demand for U.S. exports. So maybe the worsening of the current account only goes from 2.3% to 3 or 4%. But I think this is going to get much more worrisome when the U.S. is in a recession, perhaps in a couple of years, and the fiscal deficit goes from 5% of GDP to 7 or 8% of GDP.
John, what kind of recession? Is it an ugly recession? Is it a financial-led recession? Or is it something that will be completely different to what we saw last time?
My guess is going to be completely different because the sources of leverage always rotate from cycle to cycle. So we no longer have the leverage in the banking sector, but we do have the leverage in the corporate sector, potentially amongst the investor base as well. So is it going to be something that's comparable to the global financial crisis? Probably not, because of the greater stability of the banks. Is it going to be a recession that's harder to exit from because of the lack of fiscal space and also policy space on the monetary side? I think yes. So it could be shallower, but it could be much more protracted.
Okay, if it's more protracted, how important is it that actually the Fed raises interest rates despite, some movements on the markets as quickly as possible?
Well, I don't think the Fed should be acting prematurely simply to give it space to ease if the economy eventually went into recession. That, to me, is a policy mistake. But I think because the U.S. is going to have such momentum over the next couple of years, thanks to the twin fiscal easings, you might have a final level of Fed funds, which is around 3.5–4%. So that will give some scope to ease, but not as much as we've had in previous recessions.